LamboRaul is one of the most famous and popular trading influencers in the entire world. He's flashy, he's loud, and he has been around for many years, generating millions of views. And so in today's video, I'm going to be reacting to his recent video called The Real Reason You're Still an Unprofitable Trader. If you're new here, I've been running my own prop firm for over 3 years now, Lark funding thousands of traders, processing almost $1 million in payouts. I'm asking myself almost every single day, what makes the difference between a trader who succeeds and a trader who fails? So I'm very curious to see if what LamboRaul has to say lines up with some of the discoveries I've made over the last 3 years. Let's get into it.
I've worked with literally thousands of traders over the last few years, and there's a lot of commonalities between the traders that are profitable and that aren't profitable. And I'm gonna let you guys know the 3 main reasons as to why traders remain unprofitable. So it'll help you guys out in your current situation, because one thing that even Warren Buffett says is, yeah, sure, you could actually make something of yourself by learning from your own mistakes, but you'll exceed further in life when you actually learn from other people's mistakes. So the first and number one.
I mean, I have no idea what the 3 points are, but he's driving in what sort of looks to be a fancy car. Maybe it's a Lambo. So, I mean, does it even matter what he's going to say? Because, I mean, it's an expensive car.
But one thing that I've always noticed when I hop on a call with a specific trader or we're going over a group webinar and they're asking me questions, the very first thing that unprofitable traders have in common is they really just don't have an edge. They keep strategy hopping, or they have 10 different strategies that they try and execute on a daily basis. And that's actually one of the things that I almost found myself doing this year. In the beginning of the year, my playbook had a consistent list of 5 different plays that I would look to take every single day. That would be in between breakout setups, reversal setups, bounce play setups, or continuation setups. And what I did over the last, I would say probably 2 months, was I removed almost every single strategy out of my playbook and focused on just the 2 strategies that made me the majority of my money this year, which are going to be reversal setups, and they're also going to be low volume node continuation setups. So number 1 is you have to identify what your edge is. Doesn't matter what market you're trading, if you don't have an edge that you could back test and prove that those results have a positive expectancy, meaning that over a long period of time they're going to make money or at least beat the S&P 500, then it really doesn't matter what you do on a day-to-day basis. You could journal, you could execute trades, you're just not going to be profitable over a long period of time.
Okay, so I agree that for newer traders, having an edge is important. I mean, for literally every single trader in the entire world, having an edge is very important. And so strategy hopping is something that I did when I started trading almost 10 years ago. It's a very common pitfall. However, I kind of disagree with what he said regarding backtesting, of saying that you can only develop your edge through a backtesting. I've been very outspoken on this channel, very controversial, but I don't believe in backtesting. And the reason for it is I failed as a trader for many years because of poor trade execution and poor emotions. I wasn't managing my emotions, and neither of those things improve with backtesting. They actually only improve in the live market. And so literally anybody can scroll back on the chart and they could make up a strategy within 15 minutes, scroll back and say, oh, it's profitable if I do X, Y, and Z. But then they don't have the skill set to actually repeat it in the live market. And ultimately, I could not care less if I have an edge that works out it moving back in time, right? I don't care if an edge works while backtesting. I only care if it works in the live market and if I'm able to execute it. So of course, strategy hopping is very important not to do, again, because the law of large numbers, really, really important that you allow that to play out. But in terms of finding that edge, developing that edge, I disagree that it will come from backtesting. If you're brand new to trading, you don't know what a pip is, you don't know how to use TradingView, of course, use backtesting. But if you've been trading for more than 6 months, you have to get into the live market, whether that's with a $50 live account, a $50 prop firm challenge, it could be a $10 live account. You have to have some skin in the game, so you take it seriously, then you have to work out your edge in the live markets.
And this is kind of like I guess like a multi-topic part, because a lot of traders have like that beginner luck when really the market's going to go either up or down and they can make money regardless. But you need an edge to be able to make money over a long period of time. And most of you guys probably can't even answer off the top of your head what your trading strategy is right now. That's just the number one common trade that I've seen with mainly newer traders. Now, once we get into traders that are a little bit more experienced and advanced inside of the markets, the ball kind of changes a little bit here, because at that point, like, you have a strategy in place, you know what you're looking out for on a day-to-day basis, but you don't have a trading plan. Now, most traders, when they don't have a trading plan, they're trading at awkward times of the day, whether it's Asian session, London session, they're just trading outside of volatility windows when their instrument typically moves, just simply because they don't have like a consistent approach to the markets. And if you don't have a consistent approach to the markets, it's kind of like, how are you actually going to be a consistently profitable trader and make money over a long period of time if your approach to the markets isn't even consistent to begin with?
So very, very basic, high level, new trader type of advice of having a trading plan. Yes, have a trading plan. For me, the best trading plan is literally just to list out all of your rules and then to have a section where it says, okay, if X, Y, and Z happens, what do I do? If X, Y, and Z happens here, what do I do? So for example, if you're holding a trade and a major news event is coming out in 10 minutes, what do you do? If your trade comes within 5 pips of hitting your stop loss, but then comes back to break even, what do? I think you want to take all of the guesswork out of trading. You want to systemize it by having that list of rules. For me, that made a huge difference.
You're trading New York, one day you're trading Asian, one day you're trading London session, one day you're trading the New York-London crossover. Like, there's just so many different variables that it's going to be very difficult for your edge to play out and be profitable over a long period of time if you don't have a basic trading plan. Now, I've made hundreds, or I don't want to say hundreds, but I've made tons of videos on trading plans to begin with. But just to give you guys a rough draft and a breakdown as to what your trading plan should include, should be number one, the instruments you're going to be trading. Number two, your pre-market analysis time. And in your pre-market analysis time, really all you're going to list off here is your pre-market game plan for the day, what levels you're going to be looking out for, and potential plays based off of your playbook you're going to be executing at those levels, determined based off of market structure and whatever other indicators you may use. And then on top of that, you also want to check out for economic data on your pre-market plan, other than your instruments being set. So for me, I only trade ES, so my main instrument is just going to be ES or SPX. And I know a lot of people probably trade ES, NQ, and then maybe like YM, so then you would add those into your instruments. And to me, I know the volatility windows for the futures market, or for at least the S&P 500, is going to be the new, where you're keeping track of your statistics, where you're keeping track of all of the trades that you're taking. Then how do you expect to make money over a long period of time? And the probability for you to do so is going to be very slim. And I know a lot of you guys are probably like in that break-even phase, or maybe just slightly unprofitable phase, where yeah, sure, you've gotten funded but never gotten paid out. This is going to be that one critical step that's going to allow you to actually move forward into making money. Why? Because once you actually have a journal, you can see where your A+ setups are, where your A setups are, and what setups that you shouldn't be taking anymore. And that's kind of why I decided to eliminate 3 of my trading setups from my playbook overall and focus on just the 2 setups that are making me money. And then on top of that, when you go in your journal, you should be able to dissect your playbook and the specific trade setup enough to the point where you're able to determine if this is a C setup, a B setup, an A setup, or an A+ setup. So I'll give you guys a perfect example.
If you don't measure things, if you don't track things, you can't measure them. And so obviously, again, very high level, very basic trading advice of having a trading journal, but it's something that most traders don't have. And yeah, I think, just asking yourself, what did I do well? What did I not do well in this trade? What did I learn from this trade? Again, you don't have to learn from every single trade. Controversial opinion, because losses are totally normal. But again, yeah, I think having a trading journal is important. Again, very basic advice, but sometimes, the most simple advice is the best advice.
Aren't able to dissect your trading strategy that way. I was able to dissect my trading strategy right now, live in front of you guys, letting you know the differences between how I classify my A setups and my A+ setups. And now I don't blame you. Maybe you just haven't had the right mentor, you just haven't had the right guidance, you haven't been looking at the right YouTube videos, whatever the case might be is. But I'm here letting you guys know that now you need to make that change right away if you want to take trading serious and you want to treat trading as a business, more importantly. So these are the different steps that you need to take. And then on top of that, like, you should be able to go into your journal as well and go back and look at the last 40, 50 trades that you took. And one thing that I personally like to do, especially with how I'm going to determine if I'm going to let my winners try and run past my targets, is I'll set my take profit. Let's say my average take profit is set at a 5R multiple. I'll look at what percentage of the time a 5R multiple gets hit, a 4R multiple, a 3R multiple, a 2R multiple, and a 1R multiple. And then what I'll do is I'll say, okay, well, you know what? A 5R multiple gets hit 60%.
I don't think that's true. I don't think that's true. So, controversial. Obviously, you know, I don't know exactly what his trading strategy is, but after seeing the data on tens of thousands of traders, I have never once, not once, I'm not exaggerating, seen a 5-to-1 risk to reward strategy with a 60% win rate. Never. And I think this is kind of a toxic concept that we have in the trading world, especially on Instagram, you know, influencers saying, you know, you could have, you know, a 90% win rate. You could have a 10-to-1 risk to reward and win, you know, 70% of trades. It took me a really long time to understand that there's an inverse correlation between your win rate and your risk to reward. If you want to win a lot of trades, those wins are going to be small. If you want your wins to be huge, your win rate is going to be much lower. There's this inverse correlation. So you have to understand, what is it that you're optimizing for? Are you optimizing for a large risk to reward ratio? If you are, that's fine, but you have to understand you're not going to win very many trades. You can still be profitable, of course, if you let the law of large numbers play out. Whereas if you go for a really high win rate, each win is going to be smaller because your risk to reward needs to be lower. So again, 5-to-1 risk to reward ratio with a 60% win rate, I have literally never, ever seen. I'm not exaggerating. I have never seen it. Yes, 5-to-1 risk to reward trades, they happen all the time. But to say over 100 trades that you're going to get that with a 60% win rate, I have never, ever seen. So I would just encourage you to do your own research. That's all I'm going to say.
Time. Full TP, I'm getting 60% of the time at a 5R multiple. 65% of the time, I'm getting a 4R multiple. 68% of the time.
You play out those numbers. I'm just gonna say, if you were to play out those numbers at a 3-to-1 risk reward multiple with, you know, a 68%. I mean, honestly, let's actually do it. If we pull up a trading equity curve simulator, right? If we risk 1% per trade, he said that 68% of the time, so it's a 68% of the time, the risk to reward, okay, let's put 1 to 3, okay? 1 to 3, let's do 100 trades, end balance over 100 trades. That means that on a $1,000 account, he'll make 75% with maximum drawdown of 3.6%. Your max consecutive losses of 3. And that's 1.3. If we put 3.5 on a $1,000 account balance, you'll make in 100 trades 80% with maximum drawdown of 3.6%. Nothing in life is impossible. I'm just going to say that if these numbers were accurate, he would be working at Goldman Sachs. He'd be working at JP Morgan. He would be getting paid the most money in the world.
The time I'm getting a 3R multiple, 70% of the time I'm getting a 2R multiple, and then 80% of the time I'm getting a 1R multiple. So then that way I know when I enter my trade, it's like, okay, well, you know what, like every single winning trade that I've taken, 65% of them have hit a 4R multiple. So I want to try and hold.
We go back and we do 65% of a 4 multiple, 1% risk per trade. And if we start the account, we can keep it at $1,000. Again, 73.6% with max drawdown of 4%. I don't know.
Hold at least to a 4R multiple, and if we can get into that 4R multiple range, then I'll throw my stops to a 3R multiple. Different things along those lines is what helps me make money and then keep my money, more importantly. And then what also you can actually look at too, by having a really direct and in-depth journal that's no bullshit, you're just looking at numbers, you're just looking at your statistics, is you could see, okay, well, you know what, my average 5R multiple for a full TP hits about let's call it, again, 65% of the time. From that, how many of these trades actually continue to run past TP, and then how many of these trades pull all the way back to break even, and then...
It's a very good thing to journal, to track, right? Don't just journal before a trade or when you're in a trade, actually track the trade when you're out of it and see what happens. I think that's a really good thing to do.
Many of these trades pull back and then continue to run past my full TP, and you should be able to see and dissect, okay, well, you know what, 25% of the trades out of the 5-hour multiple that was hit pull back 10 points in the direction against my position. So price pulls back 10 points, and then we continue to run another 15, 25 points where I can squeeze out maybe an extra 2-hour multiple. So in the situations where you do hit full TP, you're like, damn, I think this trade can continue to run. Again, only 25% of the time, price pulls back 10 points and then continues to run to full TP. 75% of the other time, it just comes back and stops me out completely at break even. So you know what I'm gonna do? I'm gonna throw my stop loss up to where the pullback isn't only 10 points, but I'm allowing price to pull back a max of 12 points in that situation, because I know, again, 25% of the time it's going to pull back 10 points before continuing. And at that point, you know, if we start pushing past.
So overall, some very high level intro style trading advice that isn't wrong by any means. Again, sometimes the best advice is the most simple advice. So making sure you have an edge, obviously, probably fundamentally the most important thing. Journaling your trades, tracking to see what they do after the trade. I think that's all good advice. So don't disagree on any of that. Just the average risk reward, you know, I would encourage you to, you know, decide for yourself what you think about that. But ultimately, good advice overall. I'd like to hear what you guys think, and I'll see you in the next one. Peace.